Hello, good day to you. How are you doing? How are you doing? I hope you're doing great. I hope your day has been awesome because mine is great. I've been doing just very much fine. Now, I want to welcome you to another wonderful training section with financial freedom with Forex training. Now, in today's video, we are going to be talking about a very important aspect of forex trading that is going to add a lot of juice to your knowledge on forex. You have to understand this aspect because it's going to give you a better edge in forex trading. Now, we're going to be looking at what we call forex trading terms. And we're going to be looking at some important terminologies that is you have to understand as a forex trader. These terminologies are very important that you have to know how to use them, what they mean when you see them when trading. Now, the first term we're going to be looking at today is what I call PEEP. We're going to look at PEEP. We're going to look at lot size. We're going to look at what is leverage. We're going to look at what is volatility. And we're going to look at what is called liquidity. Now, before I jump into today's topic, now I believe it's very much paramount that I bring this to your notice. Now, in various industries that people find themselves in, like for example in the banking sector, now you must have heard people make use of words like loans, words like check, words like overdraft, words like bank charge. This is some of the common words that you and I can find in the banking sector. Now, as a banker, this words does not look unfamiliar to you. As a banker, it is your duty to understand what this word means. Now, also, if you go to the law sector, now the lawyers, the magistrates, you find them using words like jury. You go to the law court, you see people talking about affidavit, people talking about expertise, people talking about plaintiff, and many much like that. So in every sector, in every industry, there are some terms, there are some words that people are acquainted with. There are words that people make use of day to day in various industries. Now today, you and we are going to be looking at some of the terms that are relevant in the forex market. Some words, some terms that you have to understand if you're ready to trade, commit your money into the forex market. These words are very important. It is very vital that you get yourself acquainted with these words. Now, I'll go back to them once more. We are looking at terms like PEEP. These are very much important terms anyway. Now, there are so many terms in the forex industry. There are so many terms in the forex market, but these ones are very much important. These ones are the ones that every forex trader has to be knowledgeable about. Now, the first one here is PEEP. The second one we're going to be looking at as we proceed is what we call lot size. Then we are going to jump into what is called leverage. Why do you have to understand what leverage is? What has leverage got to do? What has leverage got to contribute to your forex trading? Now we're going to be looking at what is called volatility. When we say the market is volatile, what does it mean for the market to be volatile? Then lastly, we are going to be rounding up with the liquidity. When the market is liquid, what does it mean to say that the forex market is liquid? Now, I implore you to join me. I implore you to go along with me because there are so many we're going to be learning. Now, the first we are going to be looking at is PEEP. Now, what is a PEEP? What is a PEEP? A PEEP is the unit of measurement to express the change in the value in the market. Just like we measure time in seconds, we measure time in minutes, measure time in hours. In the forex market, as market moves, the PEEP is what you and I as a trader is looking at. The market is measured in PEEP. Now, it is nothing more than the fourth decimal number after the comma. After the comma, the comma, the PEEP is the fourth decimal number. As in this case, this one here is the PEEP. Now, it's going to be making more sense as we proceed. It's going to make more sense as we proceed. But just be sure, just note that the PEEP is the fourth number after the decimal point. Now, I'm going to be looking at how you can calculate PEEP. How do you calculate PEEP? Now, in as much as we have understand that price moves in values called pips. Whether it goes up or comes down, it is moving in pips. When price goes up, a certain number of pips has been covered. The same goes for when the price is coming down, a certain number of pips has been covered. Now, how do you actually calculate pips in the market? Why is pip important to you? How is it relevant to your trading? Now, let's take for example that you entered a trade on NZD USD at 4.56567 and exit at 4.56772. Now, how many pips? How many pips has the market moved? How many pips has the market covered within this movement? How many pips? Now, please take note, the fourth decimal number, the fourth digit after the decimal point is the pip. Now, in this case, the pip has been highlighted with blue. The 6th and the 7th here are the pip. Now, it is very, very easy. How do you work on this thing? How do you get your pip? Very, very easy. What you have to do is to subtract. Now, you subtract the smaller number from the higher number. Now, if it doesn't matter how you choose to do your subtraction, just subtract one number from the other. It can be the first number from the second or the second from the first. Now, if you decide to subtract the bigger number from the smaller number and get a decimal value or a minus before the answer, just ignore the minus. So it's all about subtracting the smaller number from the bigger one. Now, when we take away 4.56567 from 4.56772, we are going to be left with 0.00205. Now, how do you get your pip? Don't forget that the pip is the fourth decimal number. Now, in this case, you can just divide your pip by 0.0001. I'm not going to give you 20.5. Just divide by 0.001. You're going to get 20.5 pips. Now, when the market moves from this number and to this number, the market must have gone 20.5 pips. Now, because this is a fourth decimal digit pip number, you must divide by 0.001. It's very important. That's the fourth placeholders after your decimal. Now, I'm going to show you an easier way that you can do this. What if you're like myself, who doesn't like dividing? Because I'm not the dividing type of person. Now, I know there are so many people out there who don't like dividing as well. Now, I'm going to show you an easier way that you can calculate your pips. Now, this is an alternate method that you can calculate pips. Very easy. Now, looking at the same example as before, you enter the trade on NZD USD at 4.56567 and you exited at 4.56772. Now, to know how many pips you have, the market has moved either in your favor or against you. Now, we take away this number from this number, and it's going to give us 0.00205. Look at the fourth decimal number, that is the pip. The fourth decimal number is the pip. Now, the easiest method is for you to just move the decimal over 4 places to the right. Now, the pip is always the fourth digit to the right of your decimal number. Now, all you have to do is to slide your decimal point from this location. Just move it 1, 2, 3, and of course 4. Then you're going to be having 20.5. Now, the market has gone 20 pips or 20.5 pips. Now, this is an easier method that you can use to calculate pips. So it is the movement of price, either up or down. This is how you can calculate pips. Now, the next thing we're going to be looking at is what is called a pipette. Now, some brokers offer prices that are up to 5 decimal figures after the decimal point. Some brokers offer prices that are up to 5 decimal figures after the decimal point. Now, but the pip always remains the fourth digit. The pip always remains the fourth digit. Now, the fifth number after the 4 digits is called the pipette. Now, see the pipette as an imaginary number, as the invisible man. It does not exist. It does not exist. As a trader, you should always be more conversant. You should always focus on the pip. That is the fourth decimal number. Now, how do you calculate pips on a rechart? I just told you how it is calculated, but I decided to bring up this rechart for you to actually get a clearer picture or view on how pips are being calculated. Now, you entered a trade at 1.09207. That is this region. Now, the market moved down and you exited at 1.08962. Now, how many pips has the market moved in this regard? Now, the same procedure we took earlier. All you have to do is to subtract your exit price from your entry price. You subtract your exit price from your entry price. This is the case of a sell. Now, don't forget that when the market is selling, it is going down. It moves down. Selling means that the market is moving down. When the market is buying, it moves up. Now, in this chart example here, it is a sell trade. The trader entered a sell trade when the market was at this level here. That is 1.09207, and the market went in the favor of this trader, and this trader exited the market at this level here, which is 1.08962. Now, how many pips has the market moved in favor of this trader? All we have to do, like I said earlier, is to subtract your exit point from your entry point, or your exit price from your entry price. That is 1.09207, which is your entry, minus 1.08962, which is your exit point. Now, this is a 24.5 pips movement. Don't forget, the fourth decimal place is always your pip. Now, there's also an exception. Because we have different pairs in the market. Now, there's an exception with what we call yen pairs and gold pairs. Now, yen pairs in the market are the currency pairs in the market that alternate with the Japanese yen. Like, for example, we have the USD JPY, we have the Euro JPY, we have the CAD JPY, we have the AUD JPY. So any currency pair in the market that happens to alternate with the Japanese yen as a counter pair is called a yen pair. Now, we have the gold pairs. Now, the second decimal figures after the decimal point is the pip value for gold pairs and yen pairs. Therefore, the Forex pip is no longer the fourth but the second decimal place, and the pipette becomes the third. Now, I have to say this again. For yen pairs, which is the exception we are talking about here, now your pip value is always the second decimal number. Now, your broker will always serve you your decimal number up to the third decimal in yen pairs. Now, the third number after the decimal point is the pipette, while the second number remains your pip value. Now, look at the example here. If USD JPY rose from 103.25 to 103.26, now the deviation was 1 pip movement. The second decimal number, 1 pip movement. Now, looking at this snapshot here, this snapshot is just a clearer example of what we're talking about. We're talking about pip and pipette. Now, look at this pair here. Now, this is the case of maybe currency pairs like the GBP USD, the Euro CAD, and the rest that brokers offers us up to 5 decimal numbers. But this example here might be in the case of the USD JPY, that is the yen pairs or the gold pairs, where our brokers gives us numbers up to the third decimal. Now, if you happen to be trading on a pair that is up to 5 decimals, like I said earlier, your pip is always the 4th digit number. And if you are working on or trading on a pair like the yen pairs that brokers offers up to 3 decimal numbers, now the third number is your pipette, while your pip is always the second. In this case, the 5th number is your pipette, while the 4th number is your pip. Now, how do you calculate pips on the yen and gold pairs? How do you calculate your pips on the yen and gold pairs? Now, let's assume that you entered ABCXYZ. Now, this represents any yen pair or any yen pair that you decide to pick trades on. Like, for example, if you decide to go on the USD JPY or the Euro JPY or the CAD JPY or the AUD JPY, whichever one you decide to trade on. Now, let's assume that you entered a trade on either of the yen pairs at 95.343 and you exit at 95.445. Now, how many pips how many pips did the market move in your favor or against you. Now, what you have to do is to focus on the second decimal number after subtracting 95.445 from 95.343. That's subtracting your exit point from your entry point. You're going to have 0.102. Now, what do we do? What do we do by going with the alternative way of solving this thing? I don't want to divide with 0.01. All you have to do is to move your decimal point the easy way. Now, you move your decimal point from this level. Move it from this level, just 2 places to the right. 1, 2. Now, you're going to be having 10.2 pips. 10.2 pips movement. Now, in as much as we have understood what pips are in the market, let's talk about what is leverage, what is lot, what is leverage and what is lot. Now, before we look into what leverage is or what what lot is in the market, now let us recall what a pip is. Now, don't forget that the pip is the change in price of exchange rate. The pip is the change in price of exchange rate. Now, you bought or you sold, you entered a trade. You entered a trade on probably Euro GBP at 1.1301 or thereabout, and the market moves. Now, as you're in the trade, the exchange rate is changing. Now, if the exchange rate moves in your favor, you make money. If the exchange rate goes in your against you, you're losing money. Now, the movement occurs to the 0.0001 place. Very small movement. Very, very small movement. Now, let's also recall how you profit. How do you profit? You make money through capitalizing on the difference in exchange rate. You make money in capitalizing on the difference in exchange rate. If you entered a trade at a particular exchange rate and the market moves in your favor, now you're going to make money when you exit the market. If it moves against you, you're going to lose money. Now, the exchange rates change in the form of pips. Very small movement. Very small movement. Now, in order to make money in the market, you have to purchase a very large amount of currency units. You have to purchase a large amount of currency units. Now, let's assume that you enter the trade on Euro USD for a buy. You bought Euro USD at 1.10895 and you cash out at 1.10973. Now, that's a difference of 0.00078. When you subtract the price at which you cashed out from the price at which you entered the market, you're going to be having a 0.0078 difference. Now, from our knowledge of pip, this is a 7 pips change. This is a 7 pips change. Now, if you have to make money in the forex market, listen, you have to purchase a large amount of currency units. You are purchasing this unit in the amount of pips. You are purchasing this unit in the amount of pips. So to make something reasonable in the FX market, you will have to come into the market with a quite large amount of money. Now listen, it requires money to make money. You have to come in with a large amount of money for you to be able to make something. Now, this was the case of FX market before the the deception of online broker, before online brokers and the internet came into play. Before you can come into the market to make money, you have to have gathered good amounts of money. I mean, large sums of money. Now, with that difference on 7 pips, now let's look at something. Now, let's assume that you came into the market with $1. This was how it was before. This was the case before. This was the case before the internet came, before online brokers came. This was the case. When you want to come into the forex market, you have to make sure you've gathered the money. You have to come in with a large sum of money. Like I said, a very huge amount of money. A very huge amount of money. This was the case before. This was the case before. Now, let's say now that you came into the market with $1. With $1, and the market moves 7 pips in your favor. Now you're going to be making 0.00078 cents. In fact, this is not even up to 1 cent. Now, if you come into the market with $10, with $10. If you multiply this $10 with this pip value here, you're going to have 0.0078. Now, are you coming into the market with $100? Now, $100 multiplied with 0.00078. Now, this is 0.078 cents. Now, you come into the market with $1,000. Now, this is where it started getting interesting. At least here you are able to make like 78 cents for yourself. Now, when you are with $100, now you just make pretty much 8 cents here for 7-piece movement. Now, this is where you start making something reasonable a bit. Now, with $1,000 and 7-piece move, you're looking at 78 cents. 78 cents. Now, if you come into the market with $10,000, now looking at it with this pip movement, you must have made yourself $7.80. Now, if you have come in with $100,000, 7 pips movement, this would have given you $78. Now, this is the case. This is how it was. Now, if you're even coming into the market with $10,000, it is even very much laughable. People trading the FS market before now, they have to come into the market with a large sum of money. $100,000 is even very much laughable. You're looking at coming into the market with $500,000, with $1 million to $20 million for you to be able to make something reasonable. Now, notice where you start making money here. Notice where you start making money here. Now, you started making money at this range at $1,000. $1,000, you make 78 cents. $10,000, you're making $7.80. $100,000, you're looking at $78. Now, there is a name for these higher numbers. There is a name for these higher numbers. These higher numbers here has a name. They have a name. Now, what is the name? The name is called lots. The name is called lots. Lots, lots, and lots. Now, lots refer to a contract being made of a certain size, purchased in bundle of units called lot. Now, these are standardized contract sizes. Now, let's say for example, that you go to where water is sold. Like for example, here you go to a market where they sell water. Now, if you're to buy in wholesale, what you have to do is to buy this water in bundles, in cartons. That is the way it goes. Now, the same example goes. Now, let's say that you took some money, or you took like $1 to a place, to exchange $1 probably with a bureau de change. Now, if you're exchanging $1 to your currency, for example, Naira, the money you're going to make is a small amount of money, but compared to when you took a higher amount of money into the market, like for example, you're going into the market with like $200. By the time you change $200 to the currency unit, or for example Naira, now you're going to have $200 times the number, the exchange rate in that particular currency. So this is one powerful thing about lot. When we purchase currencies in the amount of lots. You have to purchase enough so that by the time the market moves, your pips move, you calculate it, you're multiplying it with the whole bundle of lots that you were able to purchase it with. Now, what are lot sizes? What are lot sizes? Now, we have various lot sizes in the market. Now, lot sizes ranges from the standard lot. A standard lot is 100,000 units of a currency. Don't forget that in the market, what you're purchasing is currency. You're purchasing the currency pair. Now, when you're purchasing this currency pair, it is purchased in value of lots. Now, a standard lot is 100,000 units. A mini lot is 10,000 units. Now, a micro lot is 1,000 units. And a nano lot is 100 units. Now, some brokers offers a standard lot or standard service. Now, the nano lot is very, very small, because if you're taking the nano lot, you are going to be making pennies. You're going to be making pennies. So a standard account, most brokers that offer the standard account, they offer you from a standard lot, a mini lot, down to a micro lot. Now, this is one thing you have to understand about lot. It is a unit that you have to purchase whenever you are about to trade the currency in the forex market. Now, how do lots correlate to profit and losses? How do we correlate lots to profit and losses. Now, if you are purchasing a standard lot which is 100,000 units, what you are purchasing is one volume. You're purchasing one volume, and the way this is calculated is if the market moves, when price moves, the market moves. If you're trading on a standard that is 100,000 units, you're making profit or loss when the market moves in one pip. You're either going to make a $10 profit or a $10 loss. That is for a standard. That is one volume. That is one volume. You're either going to make $10 loss or $10 profit. That is when market moves one pip in your favor or against your favor. So if for a standard lot account, one pip movement represents a $10 profit or loss. Now for a mini lot, which is 10,000 units, a mini lot is 10,000 units and 0.1 volume. 0.1 volume. Now when the market moves in pip, the value that is correlated in pip is $1. You either make $1 profit or $1 loss when the market moves either in your favor or against you. Now the micro lot, which is 1,000 units, is a 0.01 volume. It is represented by 0.01 volume. Now the pip movement is 10 cents per pip. 10 cents per pip. Now a nano lot, which is 100 units and a 0.001 volume, it's represented by a 1 cent profit or loss per pip movement. Now this is a real example on your MetaTrader for those of you that like trading off on the laptop. Now this is the way it looks like. Now if you look at this place where we have symbol, the symbol represents the currency pair you are working with. Now this place where we have volume, this volume is the same as your unit. Now your broker does not represent it here for you as unit. What they represent it with is volume. Now if you decide to trade with one volume, what that means is that you are trading with 100,000 units, and when the market moves in your favor or against your favor, you're going to be gaining or losing 10 pips per $10 rather per pip movement in that trade. Now this is not the only one you can use. When you click on this drop down button, you're going to be able to select any volume or any lot size that you want to trade with. Now another name for this volume is called lot size. So you can trade with one standard. With one standard, the market goes in your favor, you're making $10. If you try to increase to two standards, you're making $20 or losing $20. Now if you decide to trade with one mini which is 0.1, you're making $1 or $10. Start to trade with 0.5, which is 5 mini, that is $5 per pip movement, either against or in your favor. Now on an Android phone or on an iOS, this is the way it looks like on a phone. This is how it looks like on a phone. Now you have to click on this place and type in your volume, the lot size that you want to trade with. You have to type it in here manually, or you can either click on these areas to change it alternatively. This is the way it looks like on an iPhone, but it looks almost the same way on an Android phone. Now let us review what we've looked into earlier. Now this is the area where you start making money in the market. This is a micro contract. A micro contract, 100,000 units, $100,000. This is a mini contract, $10,000, and this is a standard contract, $100,000. Now you might be asking yourself or scratching your head and asking yourself questions like, do I need to actually come into the market with $100,000 or more to start trading? Now the answer to this question is yes. Is yes. Oh, did I just say? I'm so sorry. I just said yes. Now I'm sorry I just said yes to you, but the truth about this is you don't have to actually go about sourcing for up to $100,000 to come into the market to trade with. There is actually a way out. In fact, with the way things are now in the forex market, the good news is that you can come into the market and trade with any amount of money that you have. Now, why is this possible? What made this possible? Why can you and I come into the market even with as little as $100 and still be able to trade with the big boys? The reason for this is just one: leverage. Yeah, leverage. Leverage is very important. Leverage is what makes it possible for you and I to be able to come into the forex market and trade with whatsoever amount of money that you and I have with the big boys. Now, when I talk about the big boys, I'm talking about the banks, I'm talking about larger financial institutions, I'm talking about hedge funds. These are people that actually move the market. So we can trade with these people. We can become business partners with these big banks in the world because of what is called leverage. Now, when you sign up with your broker, you are asked to select a certain leverage amount, like 1 to 100, 1 to 200, 1 to 400, 1 to 500, even 1 to 400. Now, what you selected from your broker is what we call leverage. This is what enables you to be able to come into the market with any amount that you have. Now, see leverage like, being able to trade with, you come into the market with a small money and you are able to borrow more money to be able to achieve what you want. Now, leverage is a strategy that uses borrowed capital to increase potential future returns. It's a strategy that uses borrowed capital to increase potential future returns. Like, for example, in the real estate, people leverage in the real estate. You want to purchase a house, you can be leveraged a certain amount of money that you don't even have up to. That amount of money can be leveraged to you to purchase that particular house in the real estate. Now, see leverage as your deposit, a down payment that you made, in order to be able to get something higher than that. That is leverage. And a certain amount of money that you have to pay down for you to get another a higher amount of money. That is leverage. Now, leverage example. Now, let's say, for example, that you as you're signing up with your broker, you were asked to select leverage, and you decided to select a 1 to 200 leverage. Now, a 1 to 200 leverage. Now, what this means is that for every $1 in your account, your broker will let you leverage $200. Your broker will let you leverage $200. Now, you'll be able to use up to $200 to trade in your account if you are leveraging 1 to 200. If you selected the 1 to 200 leverage with your broker, you're going to be able to trade with up to $200 if you are coming to the market with just $1. This is the power of leverage. Now, what if you have come into the market with $10? With $10, you'll be able to leverage up to $22,000. Now, if you did a 1 to 100 leverage, and let's say, for example, you deposited or you dropped a down payment of $1,000, now you have to have access to up to $100,000 in your trading account. You'll be able to trade with up to $100,000. Now, if you have selected a leverage of 1 to 100 and you deposited $1,000 into your trading account, your broker is going to let you leverage up to $100,000. Now, what that means is that you can trade with an amount that is up to $100,000. Now, some of these things might sound very much confusing to you, but the thing there is, every of this happens behind the scenes. This is one huge favor that your broker does to you. Now, like I said earlier, the case before now was before you come to trade in the forex market, you have to come in with a large sum of money. So that was the reason why forex trading then was only meant for the big boys. Only those that had money were those that this market was actually meant for. But since the inception of the internet and online brokers, now forex has been thrown open to anybody. In as much as you can afford a small amount of money with leverage in place, you can come into the market with any amount you have and still be able to trade the market alongside with the big boys. Now, let me talk about what we call maximum leverage. Now, as you're creating your account, you will be asked to select a certain amount of leverage. Now, we have leverage ranging from 1 to 50, 1 to 100, 1 to 200, up to 1 to 4,000. Now, as you are trading, whenever you open a position, otherwise when you pick a trade, now your broker attach an amount of leverage to that particular trade. Now, the true leverage is the amount of leverage that you use at a given time. What you actually use at any given time is your true leverage. And maximum leverage is the leverage that you selected while you are creating your account. So while trading, you have to be very, very careful. Do not use all your leverage. In fact, do not risk 100% of your account just in one trade. We are going to get into money management and risk management in a later video in this training section. Now, in that aspect, we're going to teach you how you can manage your leverage, how you can manage your money. The maximum leverage is the total leverage you select while creating your account, and your true leverage is that leverage that you use at a particular time for one singular trade. Now, remember this. Don't forget this. Now, with that difference on 7 pips. Now, if you're coming in it with $1, like I said earlier, and the market goes 7 pips, now look at the amount of money you're making pennies. You're making pennies. Now you come in with a $10, you're still not making something reasonable. $100, you're still making an amount that's very laughable. Now $1,000 is when you start making something reasonable. 78 cents, not even very much reasonable, still very much laughable. Now $1,000, you're making $7.80 per pip. Now $100,000, you're making $78 per pip. Now your ROI percent can increase without having to deposit as much money. You don't have to deposit up to $100,000 anymore before you can make $78 for a 7 pip movement of price. Now that is the power of true leverage. This is what leverage can do for you. Now let's talk about ROI. ROI is return on investment. Return on investment. Now, with a $100,000 investment and a 0.0078 pip movement, which is 7 pips movement in price, you're going to make $78. Your market moves 7 pips in your favor. Now, same $78, better return on investment. Now, let me make this more clear to you. If you deposit $100,000 of your own money and make 7 pips, your return on investment will just be 0.07%. Pretty bad, huh? Now, but if you deposit $1,000 of your own money and make 7 pips using a 1 to 100 leverage, which allows you to trade up to $100,000, your return on investment would be 7%. This is much better. Now, in summary, price moves in the form of pips, just like time is calculated in seconds, in minutes, and in hours. Now, and to make money in the forex market, you need to purchase a good number of currency units. Let's say, for example, you are trading off the Euro USD in the market. Now, if you're trading the Euro USD in the market, you have to purchase a large unit of Euro USD. Like, for example, with a standard. With a standard, you're looking at a volume of 1, a standard lot. Now, what it means is you have to purchase a 100 unit of Euro USD. And when you purchase 100 units of Euro USD, price moves per pip. Now, if price moves 1 pip in your favor, you are going to make $10. You are going to make $10 of the currency. You're going to make $10 of the currency. Now, if you happen to go long or go short, and you buy or sell, and you ended up making 7 pips. Now, with a 100,000 unit, which is a standard lot, you would have made yourself $70 in the market. So you have to purchase units of currencies in the amount of pips, so to make money. Now, this was the case before the internet and online brokers surfaced. To come into the market, like I said earlier, you have to have gathered a good amount of money. You have to have a large sum of money. But with leverage, ladies and gentlemen, with leverage, any amount of money that you have, you can just come into the market with it and you still make something nice. Now, leverage is one huge favor that your broker gives you to make it possible for you to trade without having to go look for large amounts of money to trade with. Now, leverage is good, but it can hurt as bad without proper money and risk management. We are going to talk about this in a later video in this training section. It is very important that as a trader, you learn how to manage your risk, you learn how to manage your money. Now, before I round up, let's look into what is called liquidity. Now, liquidity in the forex market refers to how much money is flowing in the market at any given time. It also refers to the number of traders, buyers and sellers that are available in the market at that point in time, and their total volume. The total volume, how many standard lots they are trading with, how many mini lots they are trading with, how many micro lots they are trading with, what is the amount of leverage that they are using, and all that. Now, the average daily volume in the forex market is $5.3 trillion. The forex market is referred to as the world's largest liquid financial market, compared to the average daily volume in the New York stock market that has an average trading volume of $226 billion per day. Now, $5.3 trillion is the amount that goes in and out of the market, forex market rather, on daily basis. That's why it is referred to as the most liquid market in the world. Now, the most traded currency pairs in the market are the forex market are the Euro USD, USD JPY, and the GBP USD. Now, liquidity across these pairs fluctuates daily as the market opens and closes. Now, the forex market has about up to 4 or 5 different sections. We have the New York market, or the New York section. We have the Asian section, the Shanghai and the Dubai. We have the London section, and we have the Tokyo section. Now, the forex market is active 24 hours a day, 5.5 days a week, and this means that prices can change quickly and drastically compared to other markets in the world. Now, what is volatility? What is volatility? What is volatility? Why is it important? How does volatility relate to you as a forex trader? Why do you have to put volatility into play as a forex trader? Now, volatility is the measure of how quickly or drastically a market price changes. And a highly volatile market will see its price change more quickly and larger increments, whereas a market with lower volatility will show prices that change more gradually over time. Now, this is the reason why most traders like to trade off some certain trading sections or some certain markets. Now, there are some sections that are more volatile compared to other sections. Like the London section is very volatile. The New York section as well is very volatile compared to some of the Asian sections and that we have. Now, a market liquidity has a high impact on how volatile that market prices are. Now, so many factors can contribute as well to market volatility. As a trader, you have to be conscious of the news events that are happening around you, political events, social events, economical events, and much more. This is what a trader has to take into consideration. Volatility is often considered negative and that it represents uncertainty and risk, which is the truth. Now, however, higher volatility can even make forex more attractive to day traders. It can be your friend or your foe. It can be your friend or your foe. It creates trading opportunities, but can also create risk and uncertainty. So as a trader, you have to learn how to manage volatility. You have to learn how to manage this thing. People make good amount of money while trading forex in a very high volatile market. The same time, you can lose money if you don't manage your risk and money in the right way. Now, as a trader, you should be mindful of current events and financial news, because this will help you to better factor potential profit and avoid potential loss. Every trader has to understand this, that the fundamentals news that are going on around you plays a very high part in the forex market. Now, I want to thank you for joining us for this training today. I want to thank you for joining us, and I believe you have gotten value today. Please leave me a comment, leave your questions, and I'm looking out to answering your questions. Thank you for watching, and God bless you. Have a very nice day.